Welcome to the Whitwam Wealth Real Estate Podcast. Today our topic is what to do in a risky real estate market.
Welcome to the Whitwam Wealth Real Estate Podcast with Scott Whitwam, your blueprint to financial abundance. Settle in as we explore the mindset and methods for wealth building through real estate.
Welcome back. I'm Scott Whitwam, and we're talking about what to do in a risky real estate market. I get this question quite often from people. They're like, well, things are changing. I feel like there's a lot more risk right now. Are we facing foreclosures? Are the banks going to collapse? What is going on? What do I do? Because I feel like this market is risky. But my first piece of advice is be smart. There's two things you can do. You can be smart or you can be risky. And so if we say be smart, what does that really mean? It means don't do something that you don't have any experience in. If you think you're getting into a risky real estate market as a real estate investor, don't start wildcatting. Don't start going, oh, hey, I heard about this great new way to get rich quick in real estate, and let's try it because the market's risky and we think it'll work really good. In a risky real estate market, it's the time to just go, okay, what do I have that is working? What am I doing that is working? What are other people doing that isn't working? Where are the trends going? What is happening in our marketplace? Just be smart. One of the things that investors that I work with and challenges I've had as an investor over the years is when you get outside of your area of expertise and you start thinking that you know everything. Hey, it's been like this for 5 years. I know this works. Yeah, the whole market's changed, but that won't affect me. And I see more real estate more people who are invested in real estate get hit by the, well, it can't happen to me mentality because they weren't being smart. They started to be risky in a risky real estate market. The other thing is you got to know the numbers. I mean, it's really important to know your numbers. In a great real estate market, where you're able to buy homes really cheap and sell them really high, so you got that real advantage, you got that real swing. It's easy to be lazy with the numbers and still make money. You can do things that probably aren't the smartest and you can still make money. You can over leverage yourself. You can, spend too much cash. You can pay too much for materials. You can pay too much for labor and you're still okay. But when you get into a risky real estate market, you really have to kind of tighten your belt and know the numbers. You got to know what your costs are. You got to know where you're going to be, not only with your acquisition, but what your real ARV is going to be. What are you looking at on an ARV? Your after repaired value may have been, $650,000 in a good real estate market, but it may only be $610,000 in a risky real estate market and something where things are a little bit more tumultuous. And so you really want to know your numbers, which means you got to do your research. I know that it's tough sometimes for us because we're going so hard and going so fast, especially when you got multiple projects. But either you have to do it or you have to have somebody who can do the research. Find out what the trends are in the neighborhoods where the properties are you're looking at. What are the rental trends? Is the rental market strong or weak? Is commercial softening or is commercial strength? You really have to do your research. And sometimes it requires spending a little bit more money on doing research and on applications that will help you do better research. How many times have I heard somebody say, well, no, I didn't do that because it cost a couple $100 a month more, and yet they're losing $10,000, $15,000. I remember one time that when the foreclosure stuff was going on here many years ago, I had one of my investors who's flipped a lot of houses, decided that he was getting really good at this, so he was going to go down and buy a property at the foreclosure market. And he did not do the research. And so he calls me and goes, hey, I just acquired 123 Any Street. He says, here's how much I'm in it. Run the numbers on it. I think this is how much it's going to cost to rehab it. And he basically paid retail for the property at the foreclosure auction because he didn't do the research up front. When you get into risky markets, most people can only take a few of those before it starts to become pretty painful financially. So in a risky real estate market, we got to know our numbers. We got to do our research. We got to evaluate our investment strategy. Sometimes when markets change, we may say, hey, wait a minute, maybe I shouldn't be doing everything. Maybe you are flipping properties. Maybe you have buy and hold properties. Maybe you've got multifamily, but you have to evaluate each of your asset classes in conjunction with what's going on in the economy, and find out which classes may be still strong and stable and which classes have weakened and may be losers. And maybe it's time to liquidate a loser so that you can take that money and put it into a winner. So it's really important that we reevaluate our investment strategies when things change. It's not a failure if for some reason let's just say that you've got buy and hold duplexes in a certain state and they were really good for a time, but the industry in that state has moved out, and now all of a sudden these buy and hold investments aren't quite as good of a deal. See, if you reevaluate that on the front end, you're not sitting down here 2-3 years ago when the whole market's gone and you can't even get rid of these investment properties because there's nobody that wants them because there's nobody to rent them. So we need to reevaluate. There's nothing wrong with getting out of something in order to get in something. So we need to not only know our numbers, but we got to reevaluate what it is that we're doing on a regular basis, especially when we come to some kind of risky or challenging real estate market. We need to be adaptable, have some flexibility. I've done some real estate transactions that, and now I do them regularly, but the first time I did them, I didn't do them because it was like, wow, I saw this great video or this guru gave a talk. It was like the opportunity got presented to me. And I was like, well, no, I really don't do that in real estate. But I did the research on it. And I was flexible enough to adapt to this new real estate opportunity. And so I'm thinking about the first time I did a joint venture when somebody brought it to me. It was like, well, no, it's not really what I do. It's not the kind of real estate stuff I do, and it sounds kind of risky to me. And but again, I started to do some research. I was willing to adapt. I met with another investor, friend of mine, who has invested in a lot of the projects that I've done over the years, and we met with the attorney. We came up with a solution, and now we have our own joint venture system that we use. But because I was flexible and adapted, we've had several projects that have become very lucrative for us just because of our adaptability and flexibility in the marketplace. And we didn't just say no. The other thing is we wanted to look at things in a long-term perspective. When things get a little bit risky, sometimes what we want to do is we want to look a little further out and say, okay, I can see risky, and if I don't do this and I do this, I can see a different long-term perspective. And it may not be like it was when it was the golden years of real estate, and you could just buy anything, put any price on it, and it would sell in 2 hours. Right? So now you're starting to build a long-term perspective that says, okay, well, that expectation in this risky real estate market is maybe not realistic, but there is an opportunity here. There's an opportunity that if I don't look at things like I did, and I'm doing my research and being flexible and adaptable, that I can come up with a long-term perspective that has more safety in it and can get me through. Because one thing about in the real estate is there's cycles. Sometimes it's a seller's market, sometimes it's a buyer's market, and sometimes it's a balanced market. And whether it's a good or bad real estate market really depends on what side of it you're on. If you're a buyer and you're in a buyer's market's a great market for you, right? But if you're a seller in a buyer's market, it's a horrible market for you because you got to give up concessions, you're taking less price, you got to be flexible. But just the opposite, in a seller's market, generally, the real estate community considers that a good market because sellers can easily sell their properties. They're getting good prices, properties are appreciating. But when you're a buyer in a seller's market, it's really not a good market because you may have to pay over asking, you may have to waive appraisals and waive inspections, and and so now you have to deal with all of the risk after closing. And so, markets change. Really, for me, I think a balanced market is probably the best, where it's fairly equal for buyers and sellers. There's lots of investment opportunities generally in those marketplaces, and there's lots of buyers and sellers entering the marketplace generally in those kind of terms, because it favors both of them pretty easily. But when we have a long-term perspective, we can weather out the seasons. We can find the cycles that best fit us. And investors, we adapt and we be flexible, and that's how we stay profitable. In a risky market, we don't try to take on more risk. At least I don't. I am not a wildcat when it comes to that, because I haven't lost money in real estate very often, but back in 2006, 7, and 8, the real estate market did something that I had never seen before, and it kind of went up on its head. And so I've become a lot more risk adverse. And I really want my coaching students to experience that too when I'm coaching them, is that, this isn't about get rich quick. This is about get rich over time. And so when you have a long-term perspective, it's easier to do that. The other thing, I guess the last thing I want to say is don't be afraid to seek professional advice. Robert Kiyosaki, in his book Rich Dad, Poor Dad, talks about how he has always had coaches. Over the last 15 years or 20 years probably now, I have always had coaches. Somebody that you can bounce things off of, somebody who is, staying up and being able to provide professional guidance. I have attorneys, and so sometimes, whether you're an investor or not, sometimes it's good to have, a realtor, an attorney, and particularly a coach. So if you're a real estate investor, you really should have a real estate coach in your bag of real estate professionals, because when you get into a risky market, you want to be able to grab hold of their advice, get the information so that you can make the best decision for you and your investing goals. So this is Scott Whitwam. I want to thank you for being with us on the Whitwam Wealth Real Estate Podcast.